Hello, thank you for joining us today. My name is Johnny Garrison. I'm an institutional investment advisor at Seven Springs Wealth Group. I'm joined today with our Chief Investment Officer, Andy Michael. We wanted to begin the year. We're at the first quarter of 2026, and we'd like to begin the year with our economic and investment outlook. And again, thank you for joining us. Andy, 2025 was another year in which we saw really solid returns. It looks like markets were once again supported by lower federal funds rates, strong profit growth. As we look to the year ahead, are you anticipating a repeat performance, or do we expect maybe a divergence at some point throughout the year? And what could be the impact on capital markets?
Well, thanks, Johnny. And that really is the question that we're asking and is on top of our minds today. So as we think of things in this context of rates and profits, let's just jump into rates first and see what the market's showing us right now. So if we turn our attention first to the federal funds rate, what you can see here is the current target rate is between 3.5% and 3.75%. Here's what really grabs my attention here. The first part is that rates, the federal funds rates, is currently at a 38-month low. So we have not seen rates this low for the federal funds rate since late 2022. That is a very positive catalyst, we believe, as we head into the new year. Or even said another way, current rates are 30% below their peak. So from that top of 2023 and 2024, we are now 30% lower than where we started at that time. So if we really think about what drives the Fed to making rate decisions, as we traditionally think about the Fed making interest rate policies and rate decisions, we certainly are appreciative of there's a lot of news and noise going on with the Federal Reserve right now. But just as we traditionally think about it, it's about maximum employment and price stability. So if we look at the unemployment rate, it's at 4.4% through December, and the inflation through CPI through December is 2.7%. You may have heard us talk quite a bit last year about the 2-2-4 economy, where we'd have inflation with a 2 point something on it, GDP with a 2 point something on it, and unemployment with a 4 point something on it, as a relatively healthy economy. We're here. That's really the message here. We are at that healthy economy. I actually think it's interesting to note when rates were this point in 2022, inflation was at over 7%. Unemployment was below 4% in the threes. So this is a much more balanced economy at this interest rate level than we saw merely 3 years ago when rates were at this level. Now, the concern here that we're paying attention to, look at both of these charts. It's minor now, but both of those charts are trending higher, not lower. So typically, if we have unemployment higher, you would think the Fed would be stepping in to support that and lowering rates. But at the same time, if inflation's higher, you would also expect the Fed to step in and raise rates. So one of the big questions here is, what will the Fed do if we see both of these continue to trend higher in the new year?
Well, thank you very much, Andy. That really gives us great insight to what is driving these front end rates, these short rates, and what we could expect, from the Fed. What should our investors think about when it comes to longer rates?
Great question, Johnny. And this chart really helps to illustrate a big point here that not all rates are created equal right now. This orange line is the 2-year Treasury yield. The blue line is the 10-year Treasury yield, and the purple is the 30-year Treasury yield. This is a 3-year chart, and look what has happened in the last 3 years. 3 years ago, you got paid more interest to hold a shorter maturing Treasury bond, a 2-year bond. That has completely flipped itself on its head going into 2026. So we're seeing, I drew these lines here on purpose. This is the 4% rate. This is a 5% rate. So long as we see those long ends kind of oscillating, as you can kind of see them doing there between the 4 and 5%, to me, I would interpret that as no news, carry on. If you see those long end rates start crossing above that 5% threshold, that's where I really start to hear a lot about federal deficit problems, inflation problems, the debt. That's when you start hearing a lot of that news and attention come in, because the cost of servicing our interest, investors are demanding more interest for holding onto those bonds. On the flip side, if you see those go below 4%, that's when you're starting to see some of those growth scares come into play. So we're really watching those longer end yields, the 10-year and the 30-year. We're monitoring between that 4 and 5%. Again, if they're in between those two, we think there's no news here, carry on. If you start seeing those break between, either going below 4 or above 5, that's when it really starts capturing our attention.
Wow, so that really gives us a lot to focus on, and you've really built the fundamentals of where rates are, why we should watch them, and what we could expect from that. Let's go to the second half of what we kicked it off with. How about profit growth? What?
Yeah, I think that's a great question, Johnny. Just closing out the Fed here, we do think a new Fed chair will be appointed in May. We do expect, the market broadly expects, there to be some rate cuts as we go into this year. How many and when, unknown, but that's still the trajectory that the market's expecting. And we do expect this to be a little bit more of a contentious Federal Reserve Open Market Committee than we've seen in years past. So those are just the things that we're thinking about. And of course, we're watching all the developments with Chair Powell and who will be the new Fed chair. Will Chair Powell remain on the Fed Open Market Committee? How this new Fed chair will be able to navigate this board that has to make these collective decisions. And as we mentioned, if inflation continues to move higher or lower, as well as unemployment. But to your point, let's talk about some of those profits now. So,
Absolutely.
in 2025, we're now just about closing that out, starting to have the Q4 earnings reports coming out. We're expecting double-digit growth for 2025. What really captures our attention here is actually 2026. We're expecting, again, another around 12-13% profit growth as we move in from 25 to 26.
Wow. I mean, Andy, you mentioned the key word expecting. Every year we see the analysts come out with their expectations. And just be honest with me, how often does that actually pan out?
Well, it's certainly something to be mindful, dare I say, even cynical about, as you hear those forecasts and profits coming out, or, profiting kind of what will happen in the next year. But what might surprise a lot of investors is that when it comes to forecasting the earnings power and earnings capability of these businesses, they're actually quite good. If you look at this chart here, the left-hand side of each year is what analysts expected profits to be going into that year. And then the right-hand side is where those profits actually shook out. And what this really tells us is, barring a big shock to the economy, a shock to the system, for example, like in 2020 and 2021, we had the global COVID-19 pandemic going on. By and large, analysts are pretty good at being able to forecast where they expect those earnings to be. And so if we have this 12 or 13% expected profit growth in 26, barring one of those big shocks to the system, even if they come in a little bit below where the expectations are currently, that gives us a very strong margin of safety and error to still expect some good, solid profit growth as we move into 2026.
So, we're expecting the profit growth, as we move into 2026. Can we expect this profit growth to continue to support these valuations we see in the markets?
That's a great question. And really there's two places I want to start to look at that. The first one is profit margins. And what's really catching here is not just how we're getting earnings growth, but each dollar of revenue these companies are generating, they're creating more and more profit per dollar of revenue generated. And so, I think there's a couple of reasons for that. As we have this AI and technological evolution going on, certainly companies are getting more efficient. I think you continue to hear efficient be a big word as we go into this year. And I still believe longer term, you have this big cycling of demographics within the labor force, as you have these older, higher compensated workers continuing to exit the workforce, and you're having this younger demographic continue to enter the workforce. And that younger demographic typically comes at a lower cost than some of that higher older workforce. And so put those things combined, we're continuing to see that profit margin increase. Certainly investors are looking for that profit margin to continue to increase, putting that pressure on companies. And so that's one half of the equation. The other half is really looking at, where do we stand for valuations right now. And how much are you paying to get a dollar worth of S&P 500 earnings? Right now, the expected earnings, the forward price ratio for that is around 22 times. By no means would we consider that cheap, right? You can look at the 10-year chart here. By certainly, we are much more closer to the top end of that range over the last 10 years than we were 10 years ago. But the question is not just, is it more expensive? It's why is it more expensive? And one of the things that gives us comfort is if you're owning, just pretend the S&P 500 was a single business. We love investing in businesses that have double-digit earnings growth, that have increasing profit margins, that are buying back their shares. These are healthy things that are in a supportive economy, which is what we feel we're in right now. Those are the types of businesses that cost more to buy and own. And so in aggregate, if the S&P 500 was one business, we're just seeing it become a better and superior business that's earning that higher multiple that we're seeing here. So it's by no means a surprise. And it's certainly something we're monitoring, but not a complete concern that we're seeing those higher multiples. But anytime we're paying more for something, it calls for extra scrutiny as to why that is and will it continue.
Well, thank you very much for taking us through that journey on how this could support these valuations we've seen domestically. And everything we've talked about so far has been with stocks here in the United States. What should investors keep in mind when we look internationally?
Yeah, and it really may surprise investors that international markets really handily beat across the board their U.S. counterparts in 2025. As strong as it was for U.S. companies, international fared better. But yet again, we want to ask, why did they fare better, and will that continue into the future? So let's tackle the why first. If we look at the Eurozone and emerging markets over here, what this gray box is what we call multiple expansion. So people, simply put, were paying more for those companies at the end of 2025 than they were in the beginning of 2025. That's what the gray box represents. The purple box represents currency. So the US dollar actually weakened compared to the euro and yen and other major currencies in 2025. That means those international companies priced in their local currencies actually appreciated even more in dollar terms, which is what we as US investors care about, compared to their US counterparts. So with the currency, investors starting to pay a little bit more for those international companies, that really drove a lot of the returns in addition to some earnings and dividends for those international companies. So the big question is, can that continue? And my short answer would be, to that extent, probably not. But what we do think is that two things. One, you can see on the right-hand side here, we are still seeing those international companies trading at a discount relative to their U.S. peers, not just in aggregate, but overall compared to historical standards. So even compared to history over the last 20 years, those international companies are still trading at a discount relative to their U.S. peers, even after the big run in 2025. And the other thing that really gets us excited is the U.S. company success engine of earnings growth, increasing profit margins, buying back shares. That's not a secret only contained inside our borders. So international companies are really seeing that playbook and they're starting to replicate it. We're seeing it in Europe. We're seeing it in Japan. Of course, there's a lot of fiscal stimuluses coming from those economies as well. And so that gives us a lot of momentum for those international companies as we go into the year ahead. So we definitely think that international markets are a place worthy of investors' attention going into 26.
Interesting. Now, you mentioned the word earlier when you were talking about profit margins, and I feel like we cannot have an economic forecast or outlook without talking about AI. So we're going into what feels like it, I guess it is year four. It was 2022 when we all learned the words chat GPT. And so we're going into what feels like what seems to be year four. What should investors be thinking about at the stage we are with artificial intelligence right now? And what questions or concerns should we have?
Yeah, it's a great question, and a couple of thoughts from me here. the market's really not seeing all AI companies as created equal. You're starting to see some separation of winners and losers, and you're starting to see, again, that's not just one bundled trade. You can't just say the word AI on an earnings call and all of a sudden expect a pop. You're going to have to start delivering some real revenue increases, profit margin increases. Investors are in a bit of a show me state with these companies and their AI rollouts and their CapEx spending. And we're also seeing some separation there as well. If you're building all this CapEx expenditures out, doing these data center build outs, these chip buying, if you're supporting that with cash flow, that's great. But if you're having to take more and more debt out to that, the market's noticing that and is reflecting different share prices for those two different types of approaches. I pivot towards some of the questions for us. Are we in the early innings or in the late innings? That's really one of the big things the market's trying to figure out right now. Is this the year of agentic AI? That means is AI going to make your reservation for you for your dinner? Is it going to book your trip for you? Is it going to book your appointment for you? Not just provide you information, but actually transact on your behalf. But that's one of the big breakthroughs that's still very early innings. But once that breakthrough happens, or if it happens with mass adoption, you can really see a huge productivity unlock as a result of that. Depreciation, you've heard a lot about that in the news over the past years. All this investment that these companies have been making, they call it capital expenditures. It doesn't go against their current profits. Well, now they're going to have to start accounting for that through depreciation. So at what point does that depreciation start impacting companies' earnings? Something we're watching. Last one I'll just mention here quickly. I think the phrase AI native will start slowly infiltrating our vernacular as we move into this year and beyond. Think about Facebook and Google as an example. Those are internet native companies. They did not exist before the internet existed. We're going to continue to have companies built on an AI chassis. They were started, created, and founded on an AI chassis. That's very different than legacy companies who have been here for a long, long time and are trying to add in or add on AI as part of their workflows and processes. So let's continue to watch out for those AI native companies and see if they start creating new value, start taking market share from some of those legacy companies. That's one of the big things that we're watching this year.
Wow, so much to think about, Andy. With everything you've said during this outlook, just so much that investors are trying to process. From your view, what should we be excited about, and what concerns should we have?
Yep, great question. So we've talked about most of these on the left-hand side with revenue growth and lower rates. Financial conditions continue to loosen. We have more stimulus coming this year from the One Big Beautiful Bill Act, AI productivity gains. A big piece here we talked about with international. We're seeing smaller cap companies participate as well. The breadth of the companies succeeding continues to widen, not shrink. That's very positive. Let's talk about some of the concerns. We talked about it, starting valuations are still high. We're very cognizant anytime we feel that there's a higher price point for making that investment. Unemployment, inflation continue to trend higher. Geopolitical risk abound everywhere you turn. Will one of those really capture the market's attention and become a major issue? That AI theme is both an excitement and a concern as we have that huge spending and debt load now adding to that. Want to add to the midterm seasonality. The average drawdown in a midterm year has been 18%. And so if the market is down 18% this year, we call that average. So that's something we're definitely mindful of as we go into this year. And we'd be remiss if we didn't say it's usually the unknown that gets us right. So it's not all these concerns that we already knew about going into the year. It's that unexpected event that happens that typically shakes markets out. So always going to have the unknown as one of our concerns as we think about the new year.
So much to be excited about. There are concerns on the horizon. As investors approach this year and get into it, how should an investor position themselves to benefit from that excitement, but also address those concerns?
Yeah, 3 action items from us as we think about the new year. We think this is an important year to diversify beyond U.S. large cap. We talked about it with international. We talked about how market breadth continues to increase. So a very important time to not to continue owning US large cap, but think about other places where you can incorporate it into your portfolio. On the fixed income, we looked at it with the yields. You now get paid more to hold a longer maturing bond, something that we didn't see 3 years ago. So if you have those longer term needs, this is a great time to think about owning some of those longer term assets. And then most importantly, we feel that preparation beats prediction. Be prepared, stay flexible, have capacity to capitalize, because who knows, we could have a significantly lower, higher market this year. We could get stuck in one of those trading ranges. It could be a combination of all these things. So we just really want to be prepared, know how you might respond if you do have some of those big market volatility moves this year. Having that plan in advance of them happening really can provide investors a lot of peace of mind and confidence in and how to respond if we do get one of those major market events this year.
Thank you, Andy. So much to think about. We really appreciate you taking the time and just walking us through what's on your mind as we go into 2026 and things that we should have on our mind. Thank you, the viewer, for joining us today. If you're an existing client, if you already are working with Seven Springs and you have any questions about what Andy talked about today, please contact your advisor. We would love to answer those questions for you. If you're not yet a client of Seven Springs Wealth Group, we would love to have that conversation with you. Please reach out. We'd love to have a conversation. Thank you again and have a great day.